Hello everyone, this is Professor Choi again, and I'm here today for our second video of the series Investing for Beginners. Now I figured I would start with the stock market because that's really what a lot of people are interested in learning about today. So I'm going to go ahead and start with that, and then I'll give you my thoughts on all the other things that I covered on video number 1 about what investments are, and we'll have a conversation about what a quote-unquote good or bad investment is. But a lot of people today are interested on basically investing on the stock market. And when we say the stock market, we really don't just mean the stock market, but in reality we mean the market where you can buy all these financial securities. So the stock market is where you can buy and sell all these publicly traded stocks and financial instruments. And there are all these different sort of financial instruments that you can purchase and sell in the stock market. Now the thing that most people trade when they're trading stocks is individual stocks themselves, which can be grouped into funds or exchanges or ETFs, for example, or they can be grouped into whatever you want, but a lot of them are really just stocks put in different baskets. Now what exactly are stocks? So when you have a corporation, one of the things that you're allowed to do, or you basically have to do, is you have to designate who the owners of that corporation are. And that's really what stocks are. So if you are a corporate owner and you're the only owner of your company, then you basically hold 100% of your stock. A lot of businesses are basically private businesses. So most people, when they see a business out there, especially small ones, they could be a corporation, but they're what we call a private corporation. And private corporations could be really small, you know, mom and pop place, or they could be really large, like General Motors. Now, a private corporation is basically a company that is owned by the same people that started it. And it could be, again, a group of people, it could be a family, or it could be anybody, but basically it's usually the people who created that corporation. Some examples of that include, of course, like I said, your mom and pop business. Let's call it mom and pop. But you can also include fairly large companies, for example, like Eldorado Furniture. Now Eldorado Furniture is still, even though they're very large, they're the largest Hispanic-owned furniture store in the United States, they're still private, which basically means that they're owned by the individuals who created the company, or basically by the family members of those individuals that created the company. So the company is still private. Now a different sort of company that in many ways is still private, I guess you could call it semi-public, but not really public, is a company like the supermarket Publix. Now Publix is a employee-owned company, which basically means that in order for you to hold Publix stock, you have to have either been an employee at Publix or you have to be a current employee at Publix. Outsiders cannot trade Publix stock. So Publix is an employee-owned company. Now a public company is a type of company that you can trade in the stock market. In order to become a public company in the stock market, the process is basically to create something called an IPO, or an initial public offering. There are other processes. For example, today there are companies called SPACs, which is basically a company. It could be an actual company, it could be an idea, it could be a business that's about to get started, it could be a lot of things, by the way. That's why we call these SPACs blank check companies. Because basically, when they go quote-unquote public, it's just like a blank check. Any money that you give that company goes into this fund, and then eventually, a few years down the road, the company has to either merge or they have to stand on their own, and then they start with that capital that they have. Okay? So anyway, be very careful with these SPACs, because it could be everything and it could be absolutely nothing good for you. But in any case, most companies that are out there, excluding all these interesting ones, go through the process of an IPO, an initial public offering. And an initial public offering, believe it or not, it's an extremely complex process. So basically what happens is the company has to show that they have some kind of regular revenue stream, and then a bank will basically underwrite that security. In other words, a bank will basically show up and look for the assets that the company has, look at the revenue that that company has, and then after that, they will go out and look for investors to invest in this company. Now again, they could normally have all these people that they can call, and then these investors will buy stocks on this company at a predetermined price. Then on a particular day, the company goes what we call public. On that day that the company goes public, then now you can trade it in the stock market. A lot of the original investors that put money, that bought stock, they usually buy it at a sort of predetermined previous price before it goes public. And then one of the reasons why a lot of companies that have an IPO, the price usually skyrockets, it's because the people who invested, pre-invested, cannot sell any other stock. So a lot of what's being traded, it's a limited amount of that amount of stock, and therefore if there's a lot of demand for that limited amount of stock, the stock skyrockets very quickly when it hits the market. All right, in any case, the largest stock market in the world for second-hand traded stock, which is really what we're all trading when you go into the stock market, again, is second-hand stock, because basically it's not being issued by the company anymore, it's being given to you by another person. So it's kind of like, you know, I bought the stock from you yesterday, sell it to another person a couple years from now or tomorrow. Okay? That's really why you're trading in the stock market. Now, the largest stock market in the world is the New York Stock Exchange. And I don't mean the New York Stock Exchange, the company itself, but basically the one that we have in the United States, which is mostly something called NASDAQ and the NYSE. And a lot of this is basically being done today through computers, aka all these servers and the buildings and the institutions that kind of underpin all of that. It's what you and I normally call the stock market in the United States, which is also similar to the New York Stock Exchange and things of that sort. But in any case, who exactly are the players in this quote-unquote stock market? So you got the normal players, the investors, and the traders. Now, who exactly are these investors? There's a statistic, by the way, that keeps coming out pretty much every year, and it's extremely important for us to understand because it will tell you a lot about who exactly has money in the stock market. All right? So here's the interesting statistic about who holds most of the stock market. 1% of the United States, the quote-unquote 1%, holds pretty much 50% of all the money that's being invested in the stock market. Then there's another 19% or so that holds about 40%. And then the rest of the United States, the other 80%, they hold about 10% of the stock market. So basically, the majority of the money that you see in the stock market today represents the 1% or the top 20% income receivers in the US. So if the stock market is doing well, what it really means is that people that have a lot of money are doing well. The other 80% of the US doesn't quite care on any day-to-day, or the amount of money that they're making is almost nothing. Now, one of the things that is happening that's kind of interesting, and this has been happening because the cost of trade has been declining, is the sort of appearance of the retail investor. And when we say the retail investor, we mean pretty much anybody who wants to manage their money on their own. Okay? Most of the time, when we're talking about somebody who's fairly wealthy, they're not going to be managing the money by themselves. What they normally do is they write these checks to all these funds. So they give these funds some money, they give these other funds some money, they give these other funds some money, and then they take all those professional managers, charge them a fee for holding his fund, and then hopefully they make money, and then they just keep a clip out of all that money that they make. All right? That's what the majority of the stock market really is. But there is a large portion today that we call retail investors, which is basically people who either want to manage their own fund or they basically trade or invest on their own money. And that's really the ones that I'm talking about right here, because most professional investors don't really need. They're not beginners by definition. Most of them already have a degree usually in finance, and then they have licenses that allow them to basically do all this investment. The majority of the things that you see that I learn about the stock market are mostly self-taught, because I kind of like all this stuff and I've been really interested on it for about easily 15 years now. And I've been doing a lot of this stuff on my own. Alright, so who are these players? Usually when you want to buy or sell in the stock market, you got to go through these quote-unquote broker-dealers, or they could be brokers, or they could be dealers, or it could be both. But basically, these are the people who can connect the sellers and the buyers in the market. Another way of thinking about this, by the way, is think about a mall. Okay? So when you go to a mall, you see all these stores, and think about all those stores as being the broker-dealers. Okay? And they're the ones who have all these stock, all these different stores. The mall itself is the place where we get together to shop. So if you go into your platform, whatever that name of the platform might be, in that case it could be something like very popular like TD Ameritrade, or something like E-Trade, or something like Robinhood, or it could be a lot of other different places where you can buy and sell stock basically. All these platforms, what they basically are is a sort of storefront where you can see all these stickers for the price that you can buy or sell a particular company at any point in time, looking at the bids and the puts that are behind the scenes in all these exchanges. Okay? There's also all these different other financial institutions, and I like to kind of aggregate them, because in reality what they are is, it could be banks that are doing their own investments through some kind of broker-dealer, or the bank itself is a broker-dealer, etc. It could be complicated. Then we have mutual funds. Mutual funds is basically a sort of company that gets created so that a lot of different people can put money on it. Some mutual funds could be individually created, some mutual funds could be group created. Then we also have what we call hedge funds, and again they have all these different names, but usually a hedge fund is a company that has very few people managing it. These are usually people that are sort of risk lovers in many ways, and they're giving money by all these other rich individuals, and they're trying to make it basically a fast money in the market. So these are usually people who will be sort of doing a heck of a lot more trading, or they will be doing a lot of shorting, or they could be doing a lot of basically price discoveries that the rest of these other people are not interested on. The majority of the people in the stock market are usually people who like slowly purchase a particular asset over time, especially a company that's growing and so on. Now, most financial assets that you trade in the stock market, they have what we call a ticker. And I was in a conference with Bloomberg a while ago, and the guy who was doing the conference basically said that today everything has become tickerized. So there's a ticker for everything, and the ticker is basically the letters that represent that stock or that ETF or that fund or something like that, and everybody has a different ticker. Okay? So capital letters are normally used. Tickers could be really long, they could be really short. Really old companies usually have like one letter. So for example, Ford's been around for about 120 years, so the ticker for Ford is just F. AT&T's been around for a really long time, so the ticker for AT&T is just T. By the way, AT&T stands for American Telephone and Telegraph, in case you didn't know. So it dates back all the way to Alexander Graham Bell and the telegraph. Tick, 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 tick. That's right. So anyway, companies that have been around in the market for a really long time, they usually have like one letter. That's their ticker. And then companies that are sort of newer, they have more letters, because each thing has to be an individualized ticker for each company. So we organize a lot of these companies into what we call indexes, and this is where a lot of people get confused. So when on the news they talk about the stock market, the first thing that they talk about is the Dow Jones and the S&P 500 and something called the Russell 2000 once in a while. But basically what these indexes are is they take a bunch of stocks and they put it into this one number. Okay? Now the index is just a number that represents the value of the companies inside the index. For example, the Dow Jones is an index that is created by a company called Dow Jones, and they're supposed to represent American industrial power. So these are what we call the blue chip stocks. This is supposed to be, according to Dow Jones, the best of the best in the market. So if you want to invest on the best of the best, you don't really have to go out and look for it. According to Dow Jones, you just buy the Dow. Now, the Dow companies rotate in and out. So it's not like Dow Jones keeps the same company on the ticker forever. They don't keep the same company on the index forever. They switch them in and out. So sometimes some new ones come in, sometimes some go out. But anyway, the point is that the Dow Jones is supposed to represent, out of all the thousands of stocks you can buy in the stock market, the top 30, the best. I don't know if you agree with that, by the way, but that's what the Dow Jones is supposed to represent. All right, then another very common index is something called the S&P 500, which stands for Standard & Poor's 500. And it has in it 500 different stocks, or plus or minus 500 different stocks at any point in time. But they're supposed to represent technology in the US. So this is a sort of technology-driven index. And a lot of the companies on the S&P, therefore, are technology companies. Now we also have something called the Russell 2000, and this is an index that has become really more what the market really is versus these right here, which are specific kind of sectors of the market. Now the Russell 2000 is what we call a small cap stock, which is really companies that are smaller in market value, and then they're put in the Russell 2000, which is a small cap index. Then sometimes people quote something called the NASDAQ. The NASDAQ, to my understanding, is the largest exchange in the United States. It was created somewhere around the 60s and 70s. And this was the time where a lot of broker dealers decided to basically put all of their orders into one common place so that everybody could see everybody's orders. Okay? I want you to think about how this was done before versus after NASDAQ. So before, you would walk into some kind of broker dealer and then they would basically give you the quote for what they had. Okay? And imagine that I don't have a particular stock, then I would try to go to another broker dealer and try to sell it to you. Today, all of that stuff is automated, and NASDAQ is the largest place where that's happening. Most people, whether you like it or not, are trading within the NASDAQ system. With some examples, some brokerage houses, they give you access to a lot of these stuff directly. Some brokerage houses, they really don't do that. Some of these dealers don't do that. What they basically do is they sell their order flow to other people. So they're just a sort of middleman between the retail buyers and sellers and someone who is doing the purchasing and selling for them. It's a difference between getting a hotel through Marriott, which actually owns hotels, or getting a place through Airbnb. When you go through Airbnb, Airbnb is just the middleman between you and the person renting you the place. It's an app, okay? Now, if you go through Marriott, Marriott is the one who's going to give you the actual place. So Marriott is the full thing, full service, and then some people are just a piece on that sort of market line, okay? Now, in the stock market, you can trade all these different things, and it could be very complicated to know what's good and what's bad, and this is really where it gets extremely complex and most people don't quite understand. But you can trade individual stocks, you can trade derivatives. A derivative is something that has its value derived from something else. So for example, in the stock market, you could trade something that will track the value of oil, and people equate it to basically trading oil. What you're really trading in some of those derivatives is future oil contracts. So somebody buys on your behalf a future oil contract and then gives you a ticker for you to purchase that ticker today. With the money that the fund receives, they buy that future oil contract. If for whatever reason the price of oil is on the increase, then that future oil contract will be worth more, and therefore the ticker that they show you for this fund is increasing in value. Okay, that's what we call a derivative. So the value of the fund is derived from the value of something else. That's why it's called a derivative. All right, some things that are more, that's becoming more and more common is to trade something called an ETF. And an ETF is something called an exchange traded fund, which is basically a fund that you can buy like a ticker on the exchange. So anybody could basically get into that fund through an ETF. Some ETFs can be very specific. Let's say, for example, you want to trade only companies that invest on solar. Then there'll be a quote-unquote solar ETF. And what they do is they take a bunch of companies that sell solar panels, for example, or do anything that has to do with solar. Then they smack them into this one ticker, and then they call it an ETF, and then you buy one price all these different companies in a sort of percentage way. So what you're doing when you're buying one of these is you're giving them a specific amount of money, then they take that money that you give them and they spread it around on all these different companies and buy their stock. And that's really what you're buying when you get an ETF. Some ETFs are market ETFs, and what they basically do is they track the market. In other words, there is an ETF that you could buy that will track the Dow Jones. There's an ETF that will track the S&P 500 and so on. So if you want to buy the entire market, you can basically buy an ETF that tracks the entire market. And there are lots of these, by the way, so to pick from. You can also buy bond funds. So these are funds where basically you buy from the market, but then they take that money and they invest it on these bonds basically, and then the bonds provide a particular return, and then out of that return, the bond fund increases in value, or they pay out dividends depending on the fund. You could also buy commodities, which is basically like buying oil, buying corn, or buying things like that. You buy future contracts for any of that stuff. You could buy gasoline as a contract. Retirement funds can be bought and sold also through the market. Leverage funds can be bought in the market. A leverage fund is basically a fund where you buy something, but then they execute a particular contract that can move this value in a particular direction up and down at faster than or slower than the market. And they have to release, by the way, all this stuff to you in a prospectus. And there's a lot of other stuff, by the way, that's very interesting that you can trade in the stock market. Anyway, that's what the stock market is. And it's very complicated. So when most people are asking me a lot of these questions, I tell them, look, this is a process. It's not something that in one day, one sitting, we're going to be able to understand. As a matter of fact, most people don't quite understand it the first couple of times you talk about it. But they start getting really interested. Okay? So anyway, in my videos, what I'm going to try to do is I'm going to slowly try to explain all that stuff and how it works. And hopefully you become interested. Alright? So anyway, remember to watch the videos in order. So if you're watching number 2, make sure you watch number 1 before you get to this one. Also remember to like my video. Have a good one. This was Professor Choi.